trader. Frankly, when I was new to options trading, I remember this one just plaguing my mind. So let's see. It says, I have bought and sold, but never exercised an option. How do you exercise a call or a put? Well, folks, when it comes to options trading, the trading part is the buying to open, the selling to close. It's the actual trading of the option. But if you want to work with the actual exercise, acquiring the shares of stock, or if you were using a put to sell shares of stock, that transaction is something that requires a manual intervention. You're not going to use the website. You're not going to use the mobile app. You're actually going to call Fidelity. You're going to pick up the phone. You're going to call Fidelity, and you will ask to exercise your option, and we will go ahead and do that for you over the phone. Now, there is no commission cost to do so. But we do that for one reason and one reason only. It's because we care about you as a customer. It turns out that in most cases, exercising an option is not in your benefit. You actually lose money in most cases if you were to exercise an option. There are a few notable exceptions when it is very reasonable, in fact, the wise action to take to exercise your option. But the vast majority of situations that does not occur. Easiest way to understand this, folks, is for us to come over and take a look at an option chain. And as an example, why don't we take a look at NVIDIA, so heavily looked at in the financial news media these days. It's up 3% today. It's at $127 per share. And if we wanted to, we could go and take a look at options of any style out there. But why don't we take a quick look and think about what it would be like if we wanted to become an owner of shares. Our goal is become an owner of shares. Well, I know that the shares are worth $127.75, and this set of options that expires in September happens to have a 127 strike price option, as well as many others. And if we look at the calls, we see that we could buy this call for some $10. Now, I could buy this call for $10 and change. Then if I wanted to exercise, pay another 127. So total out of my pocket is $137. And what I would be left with is shares.
Hey, Jake, are you trying to show a different slide? Because all we're still seeing is the main title slide at this point.
Thank you very much. I clicked
Yep.
the wrong button. There we are. That should be loading up on fidelity.com now. Thanks very much, Albert. So, folks, what we're looking at here is an options chain for NVIDIA. And on the left-hand side over here, we're focused on the calls. And specifically, we're looking at this 127 strike price. We see that there's a $10 price or so that we could buy the option for. Adding that $10 that you'd have to pay to buy the option and the $127 to exercise and acquire the stock makes it clear that you would have to pay a total of about $137 for the shares in order to acquire them using the option. But I could just buy the shares themselves for $127. If we start with nothing, this situation is obvious. No one would do this. But if you already own the option in your account, sometimes that escapes us. We forget about this $10 value. If you already own this in your account, believe me, that is indeed a $10 value in your account. And you can either choose to exercise it and acquire shares using it, or you could choose to sell this and get those $10 back. If your goal was to be a share owner, then you would best be served by selling your option for $10 and using that and another $117 to buy shares at the current market price instead of exercising. As a result, folks, it's usually not in your benefit to exercise an option. There's a few notable exceptions, like I said, but we'll leave those for another discussion, or if somebody has a specific question on them, we'll bring it up. So that's our starter here. I wanted to answer one other that's kind of tied to this, Albert, and then we'll go ahead and jump right into the presentation. Folks, when we look at this, the opposite, the other end of that spectrum is assignment. So many people were asking yesterday, What does it mean to be assigned? What is assignment? Well, if I am the owner of this call and I do decide that I want to exercise it and buy the shares, paying $127, well, the other half of that transaction is assignment to somebody who sold the option. They have a negative option in their account, you might think of. They sold it to open. They are on the hook to deliver those shares to me. I buy them, they sell the shares to me. They get my cash, I get their shares. That is assignment. And we call it assignment versus exercise because I have the choice to exercise, but you, as the seller of the option, you don't have a choice on whether or not you will sell shares to me. You are being assigned and you will comply. That's something that's guaranteed and administrated by your brokers so that it can always be trusted that way. So, folks, all is well. That's what we're looking at. But exercise and assignment, I know that's a complex topic, and it looks like you have already started sending in many different questions. We'll be working through mostly your questions today. Go ahead and continue to send them in throughout. But Albert, after correcting my screen snafu there, thank you so much. Let's go ahead and get the ball rolling, and thank you for joining me today.
Yeah, I'm always happy to talk about options for a couple or for an hour at least, right? That being said, as Jake said, we'll do our best to get all the questions. If you don't mind, maybe cut me a little bit of slack. I'm going to type as fast as I can when I'm off the mic. So if I get some spelling errors, just kind of look the other way if you don't mind. I'll try to get at least the idea out there. But I did want to address a question. I think, well, I've noticed that there's a lot of questions about the same thing. So I'm going to talk real quickly about covered calls. And let's understand that the strategy of a covered call is that you own the stock and that you're selling a call against it to generate income. Now, quick show of hands, how many people think this is a bullish strategy? All right, so I see quite a few hands. The truth of the matter is, this is not a bullish strategy. This is a neutral to slightly bullish strategy, right? In other words, if we were looking at this particular stock, and I just pulled up Caterpillar just because I knew somebody had mentioned it previously, but if I'm looking at Caterpillar and I'm expecting it to go much higher from this point, probably not going to be looking at a covered call situation. And why is that? Well, two reasons. Number one, I'm going to be selling a call against my existing position, and I have to determine where that call is going to be placed. Now, if that goes above my strike, I lose out on all that appreciation, right? A covered call strategy is something we want. We think something's going to be maybe in a range or maybe just kind of move sideways for a bit of time, and we want to make some extra income by selling a call. That's the idea of a covered call. If you think that it's bullish, there are better ways to go about the situation. In fact, you already own the stock. You're already bullish at that point. To sell a cover call is really simply limiting your upside for the sake of maybe collecting some money on a premium of selling a call. So do keep that in mind. But let's take a look at a quick example of how we might go about just determining how we want to do a cover call on this particular example, Caterpillar. So here we are sitting at this level. Now, you may do your own type of research. You may come up with your own ideas as to where you might be looking at a covered call. Let's just say we're looking at this level right here, and we're thinking to ourselves, you know what, this thing has had some interaction here at this particular level, maybe around 360, 365. I think that might be something that I want to look at into. So now we're going to go to our option chain. I'm going to pull up the option chain for Caterpillar. And now we have to ask ourselves, well, how far out do we want to go? Well, you can go out as far as you want. A couple of things to keep in mind. The first thing I will point out to you is this. And the first thing that I look at immediately is right here, earnings. Their earnings are coming out on, according to this, the October 29th. That means that October 18th won't capture it. November 15th will. Now, why do I mention this? Because, folks, earnings can be a very binary event, right? It can be a situation where the stock can go either direction and pretty aggressively, right? We've seen that numerous times. So for my point, I try to typically not trade around those times. In other words, if I was looking at a cover call, I would probably consider something here or much further out. But this right here gets a little tricky because that's 2 weeks after the actual earnings release itself. I don't know what the earnings are going to look like. And so therefore, maybe I don't want to limit myself. Maybe I don't even want to be involved in the stock for the earnings, right? I want to make sure I have the ability to get out of the stock if I want to and not carry it through earnings. Being ahead of that will give me that type of flexibility. In addition, what else do we know about options? Well, we also know that when we're a seller of options, we want that time decay to work for us. We want time to pass as quickly as possible so we can keep that premium. If we stay within that window of say 30 to 60 days, that's typically when we see that time value accelerate. In other words, it comes out of that particular option quicker. So as an option seller, I'm naturally probably going to want to look in that 30 to 60-day time window. That would be inside of this October 18th. So let's just say I'm looking at October 18th for an example. 56 days, I'm in the window of when I expect that time value to accelerate. I already looked, I'm thinking, well, maybe I want to sell like this 360 call here. So maybe around $7, I'll try to sell this 360 call. Great. What is another way we can look at this? Well, I'm going to show you another opportunity. You can kind of assess what it is that you want to do or what strike to choose. And we're going to talk a little bit about this implied volatility level. At this level, it's 21.4. Let's keep that number in mind as we go forward. But I'm going to go to options and I'm going to go to probability calculator. And what this is doing is this basically giving us an opportunity to analyze our stock with regards to its volatility level. As you can see, pretty close, 24.2 is what we're looking at. And now we've got a current price, which is 345. I'm going to throw another one in there at 360 for another price. And also, I'm going to change this date right here. I'm going to change it to our expiration of our option, which was October 18th. And so now what is this? And I'm going to change this actually to one standard deviation because typically that's going to cover 68% of the outcomes. So what am I trying to do here? Well, I'm simply looking at the current level of volatility and where, based on this level of volatility, where potentially CAT could be by expiration. Now you'll notice that that 360 strike that I chose is well inside of this particular blue band. This blue band is giving us the potential outcomes based on this volatility level that we could see by the 18th. So if I'm choosing 360 because I think from a chart standpoint it looks good, that might not be the best choice from a volatility standpoint. In other words, between now and October 18th, if we stay at these current volatility levels, the stock looks like it could be a much higher. In fact, I can actually move this and adjust it to the edge of this band to try to get a corresponding level on either one of these. So if I look at this particular level of volatility and where the stock is currently, I think that realistically by October 18th, it could be between 68% chance it's going to be between 380 and 316. So if I'm actually placing that 360 call, I might be in a situation where it could get called away from me. If I want to be safe about it and say, look, I don't want to lose my stock, maybe I look at something a little bit further out like this 380 because I know that based on where we are currently, there's a chance that it could stay outside of that. There's only a 16% chance it moves above 380 based on these levels. So now I can go back to my option chain and I can take a look at the option chain for the 380s. Those are only about, maybe $2, but the thing is that $2, I can still sell that cover call and maybe feel a little bit more comfortable about where that volatility level is and where the stock could potentially be. Is it the answer? Is it telling you predicting the future? By no means, right? A lot of things can change between now and October 19th. In fact, the other aspect of this particular thing that I want to show you is if we go back to option statistics, it's important to understand where that current level of volatility stands within, say, the last 52 weeks. And if you'll notice, right now, if we take a look at where the implied volatility is at 21.4, we are at the 6th percentile of where it has been. That means that we are not even 10% of the way through the range of where this has been. So it's at a very low level of volatility. Why is that important? Let's just say, for example, it moves midpoint. So if we're talking 14 points between, or excuse me, 24 points between them, let's say 32 is about the midpoint. What does this look like if I move it to 32%? Let me readjust this to 32%. Well, as you can see, things have changed. And now that 380, if it moves to midway through that level of volatility, I might be again inside of that band. So now what do? I can adjust this back up and say, well, 390 actually, if it moves off of its low level of volatility, might be a better choice. So then we go back to our option chain one more time, 390s. Now we're trading closer to $1. Now you ask yourself, is it worth it, right? Is it worth selling it for $1 to maybe capture that dollar between now and October 18th? You'll make that decision. But those are some of the ways I would look at covered calls, some of the exercises I would go through to determine what strikes I want to use, or if it's really a trade that I want to do. Do I have an idea that Caterpillar is going to stay in a range? Maybe that changes my opinion altogether. Do I think it can stay below 380? Do I think it can stay below 360 between now and October 18th? Do I want to go longer term to get a higher premium? I could do that, but now I don't have the flexibility of being able to move around and adjust that as needed. So hopefully that answers a lot of the questions about covered calls. Again, the covered call idea is that you own the stock and you sell a call against it. It's not a bullish strategy. It's a neutral to slightly bullish. In fact, if I was to sell the 360 call, where do I want it to end up at on October 18th? I want it to end exactly at 360, right? I want to get $15 out of my stock, and I want the option to expire worthless. I want Caterpillar to be exactly at 360 at expiration if I'm writing that covered call. So just keep that in mind with regards to covered calls. I know a lot of people enjoy that strategy, and it is a very workable strategy. Just understand the limitations of it before you get involved. Jake, I'll pass it to you. Let's get on to the next question.
We had a question to clarify some of this related to exercise and assignment. Like I said, very normal for that to be the case. It's a strange topic to think through. This specific question says, does this mean that if I allow an option to expire in the money, that the stocks will not be automatically exercised? So let's go ahead and clarify some of those ideas in there. If you arrive all the way to the expiration of the option and it is in the money. So for a call, that would mean that the stock is above the strike price. Or for a put, that would mean that the stock is below the strike price. It means that there currently is value in the contract. What that means is that the expectation is for the option to be automatically exercised. And that is the case here at Fidelity. It's the case, as far as I know, across all brokers. But I can't tell you for certain what another broker's policies may be. The way it works here at Fidelity, and the recommendation from the Options Clearing Corporation that kind of monitors all of this behind the scenes, is at a 1 penny or more in the money amount, an option is automatically exercised. So you said 360 in your example there, Albert. Well, if the stock is at 360 or above, then a call owner might want to exercise. But if it's at 360 and 1 cent or above, we know that there is at least that 1 penny worth of value in it at that moment. And as a result, the expectation is that it will be automatically exercised. So if you own an option, if you bought it, then your option will be automatically exercised at expiration if the contract is in the money, unless you tell us otherwise. You can tell us otherwise. In some cases, like if it's really only 1 penny in the money, maybe it's worth saying, nah, I don't think I actually want to pay $360 to get those shares only for the 1 penny value. Maybe you would want to, if you're still bullish, you want the stock to keep going up, you think that's likely, and you're willing to and capable of coming up with the $360 to pay for the shares, great, feel free to do so. But that's what you're looking at in terms of automatic exercise. On the other side of the equation, though, if you did not buy the option, but you sold it, you don't get to choose if it gets exercised or not. Probably it will get exercised if it's in the money, but you don't know that. You just assume that that's the likely scenario. Just like I assume that the other cars are going to come to a stop when I see a red light on my lane of traffic on the road. But I'm not going to blindly assume that they stopped. I'm going to look and see and find out what they did and then make my own choice in how I will react. Same goes here with options assignment. You don't know. You'll have to wait and find out, but you can certainly be prepared. You can have your foot on the brake, as it were, ready to make your own adjustments as necessary. All right, next question. This one says, what happens when you exercise a put option in the money, either before or at expiration? If you bought a put option, you have the right to sell shares. And so if you exercise it, you are selling your shares. You will receive cash in the amount of the strike price, and you will have shares removed from your account. Now, that makes perfect sense if you already own the shares. But if you didn't own the shares, you would actually end up as what is known as a short seller. You would have negative shares in your account. And while that is a permitted activity, so long as you have margin on your account, you need to recognize that it does represent a potentially unlimited risk, where if the stock skyrocketed all of a sudden, you are on the hook to eventually buy those shares, and they may be very expensive at that time, resulting in a loss even potentially larger than your original investment. So be aware that that certainly is a risk involved with all of this. All right, next question on here coming in from Eli. Thanks for asking. Eli says, why doesn't Fidelity allow me to exercise my option on the expiration date? You are forced to call a representative to exercise your option. Well, now you know that it will automatically be exercised on the expiration date at the end of the day if it is in the money. But if the option is out of the money, there is rarely wisdom in exercising the option. Frankly, I will tell you, never is the time when that makes sense. But if you wanted to exercise early, you're right, you will have to call Fidelity. While that's an inconvenience to you, it is one inconvenience that I will wholeheartedly stand here and tell you is in your best interest. Folks, I have personally saved an individual over $10,000 because they thought it would be the best thing to exercise their option. But in reality, they would have lost those $10,000 as a result of exercising if they hadn't called and spoken to me. So please, folks, take that for a given, even if it's hard to understand at first. But the first time you expect and think, yeah, I think this is the time I want to exercise my option, you will have to call Fidelity and walk it through with the trader. They will explain what's going on and make sure you understand every little piece of it. But the point is, we want you to be benefited from the exercise, not penalized as a result of misunderstanding. All right. Next one, Frank, you say, how do we search the universe of securities to determine which stocks or ETFs would be best for a covered call? That's a great question, Frank. It results in finding a situation in which you are, like Albert pointed out, bullish, but only slightly so, or neutral. Now, looking for opportunities where you feel a little bit lukewarm about the stock sounds a little bit strange, doesn't it? We're not aggressively bullish. We certainly aren't bearish. We don't want it to go down. But we're looking for something that's more or less sideways with some positive skew. That's what we are ideally looking for. But luckily, Fidelity does have some tools that can help you find some of these. So if you come here, as I did today, to News and Research and then Options, you'll be looking at a screen just like this. In some cases, you might be instead on our updated viewpoint. So let me go ahead and show you both ways that you will access this. If yours, when you come to News and Research, then Options, looks like this with these tabs here across the top, then what you're going to do is click on Trading Ideas. And specifically, we will look for the Report Finder. The Report Finder is a list of options that can be done. This is where you can scan for any stock you're interested in and find those that currently have trading ideas and recommendations. Or if you come here to the market overview, here on the left-hand side, we have a list that says Argus Focus List. Argus is a financial analyst who publishes their opinion on whether you should buy or sell stocks, but they also include in there a specific option that you could write against it, a covered call. And here you can see some of those that are on their current viewpoint with a, frankly, scary looking annualized rate. Scary because it's so attractive. 150% on an annualized basis. When I read that as an informed financial individual, my thought is, wow, that's a lot of risk. I hope when you see this, your eyes are bulging because of the risk, not because of this promised 154% return. Please know that when you trade options, if you are looking for excessive rates of return, 100% in a year, doubling your money every year, please know that you are doing so by taking risk, maybe excessive risk. There's a reason that you are getting these. But if you like the idea of an analyst saying, yes, there is risk here, but we believe this is worth the risk, you can click here on any one of these and find the details of that specific trade. In this case, here it is for Dick's Sporting Goods. They're saying buy the shares and sell this specific call against it. This is what you could bring in as of yesterday, and these are all of the results involved. While they do maintain a buy rating on the security, that's why it made it onto that list. Nonetheless, it is worth your time to go ahead and spend just a minute and decide if it is worth your capital. In the end, it is only you that will be the winner or loser, not Argus, even though they have published this nice report for you. So I told you I'd show you how to access this regardless of how you were looking at the screen. Again, if you were on news and research and options and your screen looks like this with the tabs, click on either market overview or trading ideas, and you can find those for the given security. But if yours is this updated viewpoint, then you're going to be looking at it and it will appear slightly different. You'll look like this instead. When we type in a security, we plug in Apple this time, we're still going to have an options chain visible for us down here. But once we have that options chain, all we're going to do is use these little dots. We're going to click on the little dots. We're going to click on trading ideas. And now we're right back where we were before. So click on the little dots and then trading ideas, and then we can get to the exact same spot we were looking before. All right, folks, excellent questions so far. I want to continue them to roll in. Albert is typing nonstop. His computer's smoking already from it, and I'm doing my best to answer them here. We'll continue. I'll hit one more, Albert, before I pass it back to you, but then we will go ahead and do this. The question that I'm going to address comes in and says, can you please walk through what each column represents on the options chain? I like the view on this classic view that we were looking at initially. So let me just go ahead and pull these up one more time. Let's go back to the NVIDIA options chain, and we'll walk through what each of the different columns means here as they're displayed. But I will let you know that when you pull up your options chain, it may or may not include all of these. And there are many other columns that you can customize. You can do that by clicking here on settings and make some changes to what is visualized. But let's walk through what we do see. The most important areas are the fact that the left is calls, the right is puts, and the category here, you might call it, this little extended area, is the specific expiration. So we just notice some of those factors. And the middle column here represents the strike price. Now, as long as we've noticed those items, the expiration, the strike, and if it's a call or put, we already know almost everything about the option. In fact, those are the standardized aspects of any options contract. But let's walk through the columns. On the left, we have bid and then ask. The bid is the line of willing buyers, buyers of the option, not of the stock, buyers of the option. These are individuals raising their auction paddle saying, yes, I would buy this option and this is how much I would pay. The ask is the line of willing sellers who likewise are raising their paddle, but they're saying this is the lowest price I would sell my security for, my option. Volume is the number of handshakes today, the number of successful trades where a buyer and a seller agreed and made a trade. Specifically, it's the number of contracts traded today. Open interest, however, is looking at how many of this option existed yesterday. Notice that we have 123,000 in volume today, but only 30,000 in open interest. Open interest only updates at the end of each day. It shows us how many contracts were in force yesterday at the end of the day, in this case, 30,000. So what we can learn from this is the 123 options that were traded today must represent largely new contracts. It can't be these 30,000 contracts closing out because there are too many contracts trading today for that to be possible. So recognize that the open interest is what has been there. I like to look at open interest as saying, how many eyes are watching this option? How many people are thinking about it? Now, this first one we're looking at expires in just a couple hours. So let me go ahead and remove that off here. Let's look at instead this one going out to September, a little bit more time involved there. And now we'll see a little bit more standard scenario where the open interest usually is higher than the current volume, but not always. In this case, the 3,000 contracts traded today might be new contracts getting added to this 16,000. Or it might be people who had this 16,000 that now are closing their trades. Volume is just contracts traded. Open interest is how many remained in force at the end of the day. Implied volatility is perhaps the most abstract idea that we will look at here. It represents the expensiveness of an option. It does have an actual mathematical meaning, but it's beyond the scope of what we're going to talk about today. What you can read this as saying is higher number means more expensive, lower number means less expensive, accounting for the strike price, the current stock's value, accounting for the time till expiration, and everything else known about the stock. This is how expensive the option is on that pure basis. Delta, gamma, theta, vega, and there's a couple others that we aren't going to talk about for now, but these four are the most commonly discussed option Greeks. Greek because delta, gamma, and theta are actually Greek letters, right? And so they represent something, and each of them are helping us understand what would happen to my option if something happened. Delta tells us what would happen to my option if the stock goes up or down. Gamma tells us what would happen to my options delta if the stock goes up or down. That feels a little bit ambiguous too, doesn't it? Don't worry, you don't need to stress too much about this as a beginner at the first, but know that gamma can be important and accelerates at the end of the option's lifespan. Theta is a representation of what would happen to my option if time passes. Well, time will pass. So theta tells us how much our option will change when 1 day passes. And vega tells us what if this implied volatility number went up or down? How would that change my option? So those are the main columns that you're going to see on an options chain. Like I said, here under settings, you can add or remove many others, and you can make those adjustments to your liking. Then you save it, and it will maintain that in the future. I'd encourage you to do some customization. Don't waste this. If you're not using gamma, theta, vega, delta, feel free to remove those. Don't muddy the water for yourself, but they do present value if you understand what it is that they mean. All right, Albert, I promised I would hand the mic back to you at this point, but I love these questions. Great questions thus far, folks. Keep them coming. We'll do our best to hit as many of them as possible.
Yeah, absolutely. And if you're operating on Active Trader Pro, a couple of other columns I just want to mention in passing because I do think they're useful, especially for a beginner. And that is intrinsic value and time value. Intrinsic value, when we talk about options, we're talking about essentially, there's 6 things we're talking about options. It's of course the underlying price, the strike price, timed expiration, the volatility, and also dividend and interest rate. Now, we can ignore interest rate and dividend right now, just for now, because not every stock pays a dividend, and interest rate is not really a tradable metric unless you're doing strictly long-term options. So let's just stick to the basic 4, and that, of course, is the underlying and the strike price, timed expiration, and volatility. When we're talking about intrinsic value, that's made up of 2 of those components, which is, of course, the underlying and the strike price. All intrinsic value is telling you is how much is this option in the money. So as you can see, the 340 strike is trading 345.56. So right, or 68, it's kind of changing, but nonetheless, it's about $5.68 in the money. The 350 call, well, that's out of the money because it's above where we're currently trading. It has no intrinsic value. The time value represents the other 2 components, and that would be the volatility and the timed expiration. This is the extra part of that particular option, right? We know that the intrinsic value is 568. but this thing's trading closer to $17. Well, what's the difference? This time value. And this is if all things were to remain as they were through expiration, this is what gets eroded out of the value of that option. This is what starts to come out quicker in that 60 to 30-day time window. So these can sometimes be very helpful if you're on Active Trader Pro as well, to throw those in there just to help you understand the difference between intrinsic value and time value. Now, the other question I saw a lot of, was regarding trading, and actually, let me pull this back up. It was regarding maybe paper trading options. There's a variety of ways we can do this. I think probably the first way is to look at something like a watch list, and we can go in and create a watch list. And let me go ahead and just create one right now. I'm going to create a new watch list, and I'm going to call this, options. All right, and so I'm going to make this, and before I do that, I'm actually going to go back. All right, let me cancel that. Let me go back here real quick, because if we want to throw options into an option chain, we need to know the proper nomenclature. Now, we don't have to memorize it. You probably saw it for these particular options. So in other words, it's the symbol, the year, the month, the day, the call or put, and then the strike. So I can memorize CAT 20, 24, 10, 18, C350, or I can simply go over here. I can say, give me a quote on this particular option. I can then copy that particular strand with regards to what is going on, the symbol, and then I can go back to watch list, and I can open up a watch list, and I can create a new watch list, and then I can call this options, and then I can throw the symbol right in here. Now I've got this, and I've created my watch list. Now the nice thing about this is we've got this watch list. If I go back to this and edit it, I can actually put in a price and quantity here of that particular option. Let's say maybe I'm looking at $17 for this particular option. Excuse me, maybe I'm looking at $12 for this particular option. And I did, 12, not two, $12. I bought 5 of them. Okay, and apply. And now this will actually keep track of what that option has been doing. And so this is a good way to paper trade options. The other way to do this, which I think might actually be a bit more fun, at least for me, Jake, I don't know about you, but I can go back to this tool we were using earlier, the probability calculator, and from here, I can actually launch something called the profit and loss calculator. Nice thing about this is when we talk about options, right? When we compare stocks versus options, stocks, it's pretty straightforward, right? We're buying or selling, goes up or down. Options are a bit different. Yes, we have to understand what the underlying is doing, whether it goes up or down, but we also have to keep tabs on that timed expiration. And we also have to keep tabs on volatility, because those three components together are going to be determining the price of your option or the value of your option going forward. So this profit and loss calculator is doing exactly that. It's giving you the ability to adjust the price, the date, and the volatility level of a particular option. So what we can do is we can actually go in here and say, look, I want to add a simulated position. I'm going to say, I'm going to buy to open 5 of that October 18th, 350 calls. And we'll evaluate at a price of, we'll just make it somewhere in the midpoint. So I'll say $11.25, and I hit apply. And now, as you can see, it keeps track of the actual option itself. This will stay in here until expiration or until you remove it, allow you to continuously track what is going on with this particular option. And now you also have the ability to adjust some situations here and understand what that option might look like. So today we know that the option is at this level, but on the 18th at expiration, what is it going to look like? Well, what if we want to take a look and say, I'm not looking that far ahead. I just want to look maybe a couple of weeks out and see what this option might look like. So I know that in a couple of weeks' time, if we're trading at around this particular level, then I'm probably looking at a bit of a loss. I'm looking at this option should be worth about $9.26. So I'm looking at a bit of a loss on my position. But you have the ability to adjust these 3 parameters and to see how the option might behave. So not only is this a good way to paper trade an option, it's also a good tool for research. You can put in your options before you even trade them and start seeing how they're going to react over certain scenarios, whether it's a movement in the underlying, whether it's a movement in the volatility levels, or simply just a few days out from where we currently are. And what does that give us the ability to do? Well, it's not going to give us the ability to tell the future, but it will give us the ability to not be surprised by certain movements. If we know that in a few days' time, if volatility moves down this much and stock moves down this much, we know what to expect. And so we're not going to be surprised. And why is that important? Well, as with any trading plan, we want to remove that emotional response. We want to make it as mechanical as possible with regards to our trading plan by being aware of what potentially could be coming down the road, by understanding how things might unfold as we move forward in time, that allows us to kind of remove that emotional point of our reaction. So again, this is a great tool for not just looking at paper trades, but to give yourself a bit of research ahead of actually placing trades. So I think, at least for me, Jake, the profit and loss calculator is probably the most powerful tool that we have for options analysis. And I would highly encourage you to get in there and take a look at it. We do have a classroom that we cover this over the course of an hour. But honestly, if you're like me, the best way to learn for me is just to get in there and start playing around with it. Get in there and mess around with it, see what you can do. If you get lost, just hit reset. It'll bring it back to the proper settings that you started with, and then you can start again from scratch and start moving things around. But really, get in there and mess around with it. I think you'll see pretty quickly how it works. The other question I saw that I wanted to answer real quickly, and I'll pass it to you, Jake, is questions about regarding, again, getting back to expiration. And the question was, let's say I actually have the option in my account and I'm not sure about if I have enough money. Richard was asking, I don't have enough money to actually cover this. I'm sorry, not Richard, somebody else. Scott was asking, I think. But anyway, the point is, I've got the option. It's getting close to expiration. It's in the money. I don't necessarily have the money to cover that. How do I handle this as we get closer? Well, a couple of things to keep in mind here. Number one, the only way to close an option position is to close it, right? In other words, if you bought to open, the way to get out of that particular situation is to sell to close. As we get towards expiration, understand that if it's a 1 penny in the money, there will be an automatic expiration. If you don't have the means to support that purchase, Fidelity can and will sell out your option for you. So if you don't want to be at the mercy of what they determine the selling point will be, take care of it yourself. If it's on the day of expiration and you're watching it, call in to the service team, let them know I don't want automatic expiration or exercise. I'm watching this. I'll take care of it by the end of the day. Please be aware of what is happening on that day of expiration. As I've always said, option is trading options is a participation sport. It's not something we just throw in and walk away and come back later and see how it worked. Pay attention to those and pay attention around expiration. If you're watching it and you're going to sell it yourself before the market closes, let us know. Otherwise, it's going to be an ugly phone call when you call in and say, "What happened here?" Let's just try to avoid that altogether, right, Jake? Let's not get ourselves in that position. Pay attention and let us know your intentions, and more than happy to work with you.
Yeah, I could certainly agree with that, folks. Make sure that you manage your options yourself. We do and have to step in to manage it if the situation dictates. But if you take care of your account yourself, all the better, and then it's taken care of to your liking. So certainly can echo that same sentiment. All right, folks, let's see. We have a question that says, where on the platform can I find the high or low ticker prices as they happen? So certainly one spot for you to look at this is simply on a chart, but it does depend if you're looking for that specifically for the stock or the option. One of my favorite tools is actually right there in Active Trader Pro. Folks, that's the platform that Albert has been showing for us. If you're unfamiliar with it, don't worry. Even though it looks a little intimidating, it is extremely user-friendly once you're into the platform. I highly encourage you, if you want options trading to be a large part of your life, to make the commitment to just go ahead and download the platform. It's available for free, so there's no financial commitment, but it does require a little bit of learning. If you come up here to the options menu and then you see that options chain is what we just looked at. We were looking at the profit and loss calculator. We've used a few of these different tools. But I love on here the actual watch lists that are available. So we can create a watch list of anything that we like. Or we can just look at our current holdings in our account. So this is a test account that we have here for demonstration purposes, and it happens to have one option in it. So as we take a look here, one of my favorite ways to see the highs or lows as they happen is actually to use this watch list. We can see that for symbol C, or for the option that we have on symbol C, that's Citigroup, the bank, if we come over and take a look, today, the range for these has been 60.74 to 62.46. And right now, we're right here in the middle of it. Or in this case, the option hasn't really seen any activity going on, only at 9 cents. So we're right here in between 9 cents. Meanwhile, we also have the 52-week range available here. The columns are available for customization. So you can go ahead and right click this and adjust them to be whatever you would like, add all sorts of details, remove, you make those customizations. Those watch list customizability is one of the most phenomenal features Fidelity offers. So certainly make use of that if you want to take a look at them. If you wanted to instead see just in a visual format like this, what's happening, this is the price of the S&P 500 every minute. Actually, I'm sorry, this is every 5 minutes that we're seeing. So if you look at this area over here on the far right, we'll notice that it's ticking up and down ever so slightly, representing the most recent price change as it goes through, and that can show you those as well. So those would be your areas to take a look at price as it comes through. Matt, you were wondering, does Fidelity have any reporting tools that can help me monitor and review my options trading successes and failures? We do have a few things available, but I would tell you that in terms of robust trade journaling, Fidelity doesn't dive too much into that market, but there are a few people out there in the internet that have created phenomenal software for that kind of trade review. Personally, I just keep a spreadsheet and I write down, this is what I did, this is why I did it, and then later on, I write, well, that was a good idea, that was a bad idea, and we can see why. So you decide how much you would like to, but the things that you can use here at Fidelity, while you have the trade open, I encourage you to come to this accounts and trade, and then you can use the option summary, which sorts it either by underlying strategy or expiration. We'll take a look at the strategy version here for just a moment. And it tells us, all right, we have a long call in this account on Snap. We have some shares and shares alone, long stock, it tells us. And we have a covered call. So these are the different strategies we have currently. It tells us our gains and our losses. It can give us ideas on what's happening related to those Greeks that we talked about previously, delta and theta, and much, much more. So you can get all sorts of details about open trades like this. Or if you wanted to study what happened on your previous trades, you come here to closed positions and you can say, all right, I want to look for symbols that start with C. Okay, we have just one trade over the course of this year related to Citigroup, and this is what's happened with it. So you can kind of dive in and take a look at those along the way. Want more detail, want a spot to write down your thoughts on why, on how, I strongly encourage it, but it's not a tool that Fidelity provides. Chris, you say, do you have a recommendation one way or the other, whether to use Active Trader Pro or the Fidelity website to research and trade options? My preference is absolutely Active Trader Pro. It's the one that's designed and built for options traders. It's where you're going to see us spend most of our time, both for coming up with trade ideas as well as where Albert and myself are behind the scenes placing our own trades when the time comes. That said, the Fidelity website does a phenomenal job, and nothing against those of you who choose to use the website. My main hiccup using options on Fidelity's website is on some of those trade screens. Even though the quote is real time, meaning it's telling you exactly what the price is at the moment you load up that page, it doesn't stream the price and change. If you notice where my mouse is hovering, Citigroup will change in price while I'm sitting here, and I'll get a constant stream of updates to those prices. So Active Trader Pro is built for that. Keep me informed. I want to see it to make my decision right now. Frame of mind. If you're trading occasionally, you don't want to have the software, or maybe you're trading on your work computer between meetings and you don't have the ability to download software. I've spoken to many people in that situation. Well, the Fidelity website will absolutely get it done. So no harm if you do that. My preference is certainly Active Trader Pro. Wayne, you were wondering a little bit more about how to use those profit and loss graphs. They're hard to wrap your mind around at first. But let me just break it down for you like this. We'll look at the one for Citigroup with our trade on there. What's happening is the graph here is representing the price from left to right. So price low is over here 58, and then it goes up to 68, and then up here 78. That's what's happening here. Stock price, and then up and down tells us, are we winning or are we losing? Are we making money? Are we losing? Those are the things that we're thinking about as we work through that presentation, and certainly would encourage you to take a look at it. So when we use this visual, what I see is if the stock goes up over here to the right, I win. But it stops winning if it gets over this $75 mark. So I'm bullish, but neutral as well, because at some point I stop caring if it goes up further and further. That's where the bullish to neutral comes from a covered call. Or if I looked at my shares alone, well, now the higher up the shares go, the better it is for me. Or if I isolate just the call, well, it turns out going up is losing for me. It turns out it only loses in direct proportion to the amount of the call of the shares also going up. That's why together we call this a bullish to neutral strategy. So I hope that helps you understand a little bit more. Play around with it would be my recommendation, Wayne, and start with that idea. If the stock goes up to the right, what happens? If it goes left, what happens? That's your key. I'll answer one or two more and then I'll pass it back to you here, Albert. We are getting close to the end of time here, folks. So get in those last couple questions. We'll try and answer them. But it looks like we've got so many in here, we're not going to be able to get to all. For those of you who asked a question that didn't get answered today, thank you for attending anyway. I hope you still got a lot of value. Charlotta says, I am allowed to only do covered calls and cash secured puts in your IRA. Great point. In an IRA, there are limits to what types of trades are allowed. These aren't necessarily Fidelity imposed limits. Some of it comes directly from the IRS saying that you can't take unsecured risks in your IRA, but nonetheless, Fidelity does have our hand in it as well, as we are the ones who approve your options trading requests. So know that in an IRA, you are able to place covered calls, cash secured puts, purchases of calls, purchases of puts, as well as spreads trading. All of that is available in an IRA with an appropriate options trading level. If any of those are of interest to you, but you don't believe your account allows it currently, call in to one of our traders. They'll walk you through what you would need to do in order to get that enabled. And certainly we encourage you to be mindful of the risks that you're taking with any money. But the special money set aside for retirement, of course, has that much extra importance for many people. There was also a repeat question that I'll answer for everybody. I hope this will address it for most. A lot of you were asking for a recording either of today's class or of the webinar yesterday. The webinar yesterday was recorded. We expect that within the next week, week and a half, it will go through all of the necessary compliance reviews and editing to then be published to the website. When that happens, everybody that joined us is going to receive an email that says, hey, it's available to watch, and you can go ahead and take a look at it then. So expect a week, week and a half, and then you'll see that. However, this class that you're attending today does not get published. It's also recorded, but that's just to make sure Albert and myself didn't go too far off the rails, not published hereafter. That said, we do have a few resources and opportunities for you to continue this if you wanted to spend extra time following along. For example, next week, we'll be back with a couple of important sessions that I would encourage you to take a look at. I'm going to direct us to Fidelity's website, but I'm going to navigate to it the same way I hope you will in the future. Fidelity.com/coaching is the website. Fidelity.com/coaching. Fidelity.com/coaching takes us to this page that has all sorts of great details about our upcoming classes. There's a few that I would point you towards. For example, all of you interested in the options trading related information, you can click here on this find a session, and you'll find that in just the next few days, we've got several different classes related to those topics we've already discussed today and diving deeper into others. For example, come August the 28th, we've got a class all about writing covered calls, everything there is to think about when you consider selling that covered call against shares. 2:30 on August 28th. If you're somebody who, having attended the classes today, are thinking, well, how do you even know if you should sell a covered call? Is it going to go up? How's it going down? How do I make that decision? I would encourage you instead to join us at some of our daily market briefings, where we show you how to use technical analysis in real time, taking a look at charts, explaining what's happening in the markets at any given time, and also walking you through the thought process. That's going to help you build this idea of, should I be bullish? Should I be bearish? How do I come to those decisions? And certainly I would encourage you to join us for some of those. For example, this afternoon, 4 o'clock, as soon as the market closes, you will find those right here. Again, the website is fidelity.com/coaching. Then I clicked on daily market briefings if you're looking to figure out, how do I make this decision? One third and final resource, then we'll answer a couple last questions. For those of you who think, you know what, I love this option stuff, it's so interesting, but I really just need like a more defined curriculum. Let's work through it piece by piece. Come with me to one different website. This is fidelity.com/classroom is the website. Fidelity.com/classroom. The first one was coaching. This one is classroom. Fidelity.com/classroom. And right down here, we find that there's a class all about how to use Active Trader Pro. If that was a little intimidating to you, hop in. We've got 4 weeks dedicated to explaining this to you, 1 hour per week at a time that makes sense for your schedule. Options for beginners. For those of you who want to start from the ground up, let's just start from scratch. Or if you think you've already got your handle pretty well on options, but you'd like to take it to the next level, options intermediate. Any of these would be great resources. As an example, let's click on Learn More for Beginners, and let's see how this options class looks. Starting in September, on the 5th, we will have every Thursday at 2:30 a 1 hour session breaking down what's happening in the options. You can take a look at this, you can join us, you can ask your questions just like you did today, but we'll have a more defined curriculum. We'll have slides for you to take a look at and to walk home with, all available there at your fingertips. All of this is available to you at no cost, and there's a likelihood you'll see Albert or myself backing them. We also have about a dozen colleagues that do this job as well that we interchange with. They're at least as capable as us, far more than me, but maybe only on Albert's level. So thank you so much, folks, for joining with us. If you have to run, it looks like we did run up right up against time. Albert, let me give it to you to address the one last most important question.
I want to actually use this for an opportunity for a public service announcement, because I think I saw a couple of questions about this. And I just want to make sure that we're all on the same page here before we depart. And that is with actual execution of trades. I noticed a lot of people were asking about certain types of orders, stop limits, things like that. You can absolutely use those with options, but here's what I want to tell you, and that is that if we take a look at, I pulled up SPY. This is the largest and most actively traded ETF out there. Take a look at some of the spreads. And this is for August 30th expiration. We can look at a variety of different expirations, but take a look at the bid-ask spread on some of these, right? 3 cents. Most of them are 3 cents, 2 cents, 1 cent. If you're using those types of orders in here, that may not be an issue, right? Because if we were to put in a stop order with this trigger here, where do we get filled? We get filled 2 cents lower. That's probably reasonable slippage, is what we call that in the business, between actual execution and the order we wanted to place. Now, let's go take a look at something a little bit different. Let's go back to that cat that I was looking at earlier. And we're going to notice that the spreads here are substantially wider, right? 20 cents on a lot of these, maybe even up to 30 cents. And what does that mean? That means that if I was to put in a stop at 490 and it gets triggered, where am I getting filled? Well, I'm getting filled at 460. So options are a lot different than stocks from the standpoint that they're not always the tightest spreads. So you can do that. You can use those types of orders, but understand what is going to happen if you use them. If you were to put in a stop at 490 and it gets triggered, you're getting filled somewhere down here, potentially at 460. If you put in a limit of 490 and the next trade's at 460 and it keeps going lower, you're not getting filled. So please understand the difference there, because that can certainly make or break a trade. It can also be a very frustrating thing to watch that play out when you were hoping to get a different type of execution. Understand how those orders work, especially with options, because options, again, they're not going to be nearly as liquid as, I say, a single stock or an ETF when you're looking at them. So that's my public service announcement for the day. As a former market maker, liquidity is very important to me, and I don't want you to get caught in some of the situations that I've learned over the years. So hopefully that'll help you avoid some of those situations. But I'll leave the last words to you, Jake. Always a pleasure to share the screen with you. Thanks so much, everyone, for being here today. Hopefully we'll see you again in some other sessions. But everyone have a great rest of your day, great weekend, and we'll see you next time.